Good afternoon, everybody. Welcome to today's second of our series of webinars for our strategies. For those of you who don't know me, my name is Jonathan Wu. I'm one of the executive directors and chief investment specialist here at Premium Asia. Really happy to see a lot of familiar faces attending today. Obviously, this is the first time we're providing a formal update to our Asian income fund for the year. So there's quite a lot to discuss. Obviously, the positive backdrop to that has been that performance has been very strong over the last couple of months, reflecting our views and the way that we position the portfolio sort of going into late 23, which I'll talk about obviously in a bit more detail later on, and sort of also see where the outlook is and where sort of we believe some of the drivers of returns will be for 24, because we think it's going to be quite different to 23, and we sort of aligned our views to a portfolio in that way. We have some direct investors on the call today, so just a reminder that everything I present today is general in nature. There is no personal advice given. If you are looking to consider making an investment in our funds or any other financial decision or investment decision, please seek the advice of your registered financial advisor. So why is it a good time to invest into Asian corporate debt? Obviously, the valuation set is still quite attractive, and I'm going to look at that from both a market lens as well as where it stands for our funds. The second thing is Fed fund rate has peaked. And as we all know in previous cycles over many, many decades, when the Fed funds rate starts to fall is a good inflow opportunity for emerging markets overall. And that should be no different in this cycle that we're heading into. Obviously, even though there is, if we consider where we sat a month ago with regards to the market pricing in Fed funds rate dropping 6 times this year, that's now dropped to about 3 in the most recent reading. And obviously, Powell came out and talked about that last night. So, even though the magnitude may fall, it is still a positive skew towards emerging market, both equities and bonds. And thirdly, for those of you that I sort of talked to from about the middle of last year and you saw, things start to stabilize, well, we're now way past stabilization. And we've started already to see that uptick. And in actual fact, Asian corporate bonds are sitting in this, what we call a space that's dislocated, but not distressed. And what we mean by that is when you have a market that is distressed, you have a lot of sellers in the market, and there is some fundamental reason that's driving that level of market activity. When the market is dislocated, on the other hand, is that dislocation refers to what is fundamentals and reality versus sentiment. And so everyone that has gotten out of the Asian bond market has already exited. And so therefore, because not many people or not many institutional investors are interested, that's where there's no demand. There has been still some weakness on primary issuance, more so to do with China than any other countries, which I will talk about, especially with India and Indonesia specifically. But what we have seen is that investors going in now is going into a completely cleaned market. And then you sort of double down that investment thesis and consider that you're buying into an active strategy, and therefore we are cherry picking the best ideas in the market. You're not getting a passive exposure, and our performance track record has proven that over time in terms of the amount of value add we've been able to generate for investors, net of fees. So just a recap of our team, Value Partners being based in Hong Kong. 3/4 of the equity is actually held as part of the listed co. Still the only asset manager listed in Hong Kong. We're boutique in size, and for a reason, because we want to be able to manage smaller funds in order to generate that value add. Because what we are effectively, providing to the market are niche style products that does form a good value add, non-correlated exposure to all the other types of assets that you held for your clients' portfolios. And with over 50 investment professionals covering both the Greater China and Asia ex-Japan region, that is also one of the most concentrated teams, where we undertake 6,500 company visits. And ultimately, if you look at the philosophy, it's not a, it's not some sort of magical philosophy. We are pragmatic value. So we're looking for things that are cheaper than their, underlying price. And in the case of bonds, we're trying to find things that are under 100 cents in the dollar and allows us to make good cash yield of at least 6%, which we then pass on to your investors as well as yourselves, and while still making ample capital gains from being that value style manager. So we do not strike out any particular industry. Everything is on the table for us as long as it provides good value, right? A good company doesn't mean it provides good value, and vice versa as well. As long as it is at the right price, we're happy to own anything along the spectrum. Excuse me. This is our team. We've got Gordon Ip, who's the daily portfolio manager. And as for those of you that are following more closely to our strategy, 3 years ago, we added Anna Ho, who's the head of credit strategy, and she has been a massive value add to the process and really drilling down on providing both top-down ideas in terms of where we're sitting, in terms of certain sectors or industries that could be of interest, like say, even geographical sites like Macau all of a sudden becomes interesting, or Mongolian miners become interesting, or Indonesian property becomes interesting. But what we see with a lot of investors is that you're either generally good at giving top-down ideas, being sort of at an industry level, but you can't really generate bottom-up, or vice versa. You're not a top-down person, but you're a bottom-up focused investment person, and therefore you can just generate the ideas at an individual bond holding or security level. Well, Anna is actually really good in providing both, saying Macau's a really good idea, which I'll talk about in a minute as well. But at the same time, out of the sort of 7 names we can see in Macau, 6 of them I think are worthwhile to have a look at. So what are we trying to achieve for the Premium Asia Income Fund? It is predominantly a high yield fund, so represented by the big blue bubble that you see there. 96%, sorry, 93% of the fund at a minimum, so to be very clear, at a minimum, is just trying to buy very stock standard bond securities, generally corporate. We do opportunistically participate in sovereign debt, but most of the time it doesn't provide the alpha that we're after. So it's generally been quite tactical, and happy to talk through a couple of those examples later for those of you that are interested. And then what we try to do is we do new issues trading. So primary issuance on the market, we'll do primary trading to eke out a bit of alpha. And we'll also do, at a maximum, 7% of the portfolio could go into special situation or event or distressed debt. As it stands at the moment with our portfolio, there is no special situations. It is a very bland bond fund, generating a yield to maturity of about 12%. So it's effectively as boring as it gets, especially in a dislocated market. What we then do after coming up with those ideas and forming a portfolio without a huge level of tail risk, being that we don't have concentration on our top 10 holdings, we then overlay an active currency hedge. And that's probably a key to one of our successes in Australia and by extension in New Zealand, is that a lot of bond funds and credit funds that have been offered in Australia, especially in the emerging market debt space, has been effectively taking a US dollar unit class and then basically putting into Australia and not providing any sort of protection from a currency standpoint. Now, as we all know, as equity investors, we generally are happy to take on some level of foreign exchange risk, due to sort of, I guess, the upper echelon returns, longer term currency washout. But with a bond fund where you're primarily trying to generate income out of it, one of the outcomes of that is that you don't want foreign exchange to be effectively wiping out total portfolio performance for a year or doubling portfolio performance in the next year. So with the active currency hedging, it has meant that we've created a lower volatile strategy for our funds. It adds another level of protection in terms of shielding clients from macro events like COVID, which we did very well. And then it really then allows our clients to really focus on that 6% yield and the small incremental value of capital gains each year in the portfolio. This is what's made us successful. It's what's made us the largest emerging market debt fund available in Australia and New Zealand. And it's because of the fact it's not correlated to anything else in your portfolios. That's also, I guess, a reason for its success. So we don't take anything for granted. Everything's about bottom-up analysis. We don't try to do anything by shortcutting. We don't follow credit ratings. Our belief and part of our core, I guess, tenet of our philosophy is that credit ratings provided by external research houses do not provide forward forecasting. They are simply backward looking. And therefore, the difference is that what we're trying to do is that we're trying to find those corporate bonds and corporate credit where analysts on the sell side are simply not covering, right? Or the research houses aren't covering, which gives us better access to better spread, and therefore generating alpha if we're picking the right ones through bottom-up credit analysis. To give you an illustration and point of what we're doing right now on 100% of the portfolio is we're trying to identify things that other people are ignoring from a research house perspective, and SoftBank Group was one that we traded out in the middle of last year. So SoftBank, most of you will know, is one of the largest telcos in Japan. Now, one of the things about the Japanese culture is that they're very, very patriotic. And therefore, at a public level, if you look at the largest holder of public debt being Japanese government bonds or JGBs, it's the Japanese public. And then the single largest holder or demographic group that holds Japanese corporate debt is Japanese public. And so therefore, it is a very sort of self-fulfilling prophecy that every time one of these large institutional names comes out and issues debt, it is very, very well supported by the local public. Now, SoftBank is a BB+, which is at the highest end of the high yield spectrum, and they had a 6% perpetual bond issued out to the market. Now, with perpetual bonds, as you know, with a lot of hybrids, even in Australia, there are still some call dates that occur through the life of the hybrid or the bond, of which for SoftBank, the first call date was the 19th of July 2023. And so, we bought it for a good yield because it was paying 6%, so it meets our target. But at the same time, it was trading at low to mid 90s. To the dollar in mid 2022. And when we looked at the balance sheet of SoftBank Group and therefore its ability to repay both the income as well as the capital, we drew a lot of comfort in thinking that there's probably a reasonable chance that they will call the bond in June of 2023. And that's exactly what happened. We got paid back 100 cents. There is no dislocation. There is no distress. This is what our fund primarily does. Okay, and we also don't take a whole lot of duration, or we don't take a lot of bonds that are maturing 30 years down the track, unless just by chance it is 30 years down the track. Could be a sovereign piece of debt, but we're tactically trading it for capital gain in the short term. So this is what we do. Right? Bread and butter, day to day, no looking at research ratings because we don't find any value. And over the course of time, it has been proven that those research reports are generally not worth the paper that they're written on. So with regards to where we're sitting in terms of the economy, China at the moment is the last major economy that hasn't recovered. And frankly, there was a hope that at the beginning of 2023 that would occur. It didn't. And the key rationale for that, and it didn't drive that huge level of what we call revenge spending in the economy, is due to the property market, right? And so that's where I'm going to talk a fair bit about today, because ultimately, for the economy to come out of the doldrums that it has been in, it's all about confidence. And for those of you that joined us on the Tuesday call with regards to the equities market, you would have seen that effectively all of the return of the Chinese equity market last year being negative 12% was driven 80% by PE contraction, right? Nothing else. Earnings was actually flat. And so going forward in this year, if the government can show their policy stance towards property is going to be more about delivering, of which they started doing last year, I'll talk about that in a minute, is that that will bring the consumer at a high level of confidence to then on spend in other sectors. Okay, now we're not banking on that for this fund. I'm just speaking at a very macro level because we're just buying the income stream from the cash flow of the bonds plus a capital gain at the back end if they are balance sheet strong. But if you're thinking about what's going to happen, I mean, right now we're in the middle of NPC. the two sessions, not MPC. I'm getting mixed up. The two sessions, and they're sort of talking about some policy. Nothing major has come out of it. We still stand by the fact that we are waiting for the third plenum, and the third plenum is where most of the positive policies come out, which is then actually seen in the last five. Um, in the last five political cycles, you have seen that the equity market responds mainly between the third and the fifth plenum, right? So that's when people, again, a reflection of confidence starts to come through. What is also doubling down as part of that confidence is that, um, and what is very different about, last year I spent a lot of time, a lot of clients had a lot of questions around whether or not China is actually the next Japan. Well, it frankly is not. Okay, the key issue for Japan was that the corporate sector was overly indebted. And what you see here on the right-hand side is it exemplifies two concepts that I sort of want to walk through. The first concept is POEs, or privately owned enterprises, have very low levels of debt. Even central, being federal SOEs, and local SOEs also don't carry a whole lot of debt, right? This is very different to the Japanese story. The other thing that this chart actually also sort of expresses or explains is the concept of why the Chinese government hasn't thrown the baby out with the bathwater or thrown the kitchen sink at it in terms of just pumping a huge amount of liquidity in the system. They have been, right? They have been pumping some levels of liquidity, and we've seen things over the last month, like say cutting the required reserve ratios again, pumping an extra trillion RMB into the system, or also cutting interest rates, which is the 5-year prime loan rate. So let's call that's probably the closest thing to an RBA cash rate, is those have been cut as well. We don't read about it, right? But it's gone from 4.65 in the middle of 2021 till now 3.95%. And explains why the government's doing this piecemeal with regards to stimulus. Because the last time they did the stimulus, can you sort of see from 2008 all the way through to 2014, there is this huge uptick in indebtedness. And from from an SOE perspective, state-owned enterprises, the government spent the better part of the next decade just trying to deleverage, right? So there are consequences to throwing the kitchen sink with regards to stimulus, but the government is doing things. And right now, the amount of savings for the Chinese consumer is sitting at around 42 trillion RMB. Okay, 4 trillion of that was accumulated during COVID, but it just keeps growing and people aren't spending. And if you look at the last 30 years worth of data and put a line of best fit around the level of savings for Chinese people, it's about 28% above trend. That's how strong it is at the moment. And despite everything that you see and you read, what we need to also remember is that most of Chinese GDP growth actually does come from the consumer. It is actually not that different from the Western world. And this year they're targeting 5%. 3 days ago, the President Xi announced that they're targeting around 5% GDP growth this year. They outperformed it last year by achieving 5.2%. But you see that most of the growth is coming from consumer, which is the gray part of each of these vertical bars. And net exports is sort of the lighter blue part, which in 4 of the last 10 years has been a negative contributor to growth. And in most other years, it hasn't been a huge contributor to growth at all. So sort of going back to the property sector, of which we have very, very little exposure left, to be very clear, is that the government is doing things. So as I said, they've cut reserve ratios, they've cut interest rates. Last year in August, they changed the down deposit for property at 20%. They have redefined what is a first home. Because previously, if you bought a first home and then you sold it to buy a second home, that was actually a second home and therefore subject to second home rules, which had impacts on the amount you could deposit and things like that. Also, banks are now allowed to cut interest rates, which is probably the other big interesting part that comes out of that on existing mortgages, and they can cut up to about 73 basis points. So everything is trying to bring support to the property market. Furthermore, last year, the government created a development whitelist, which is 8,200 developments right across the country, of which they are basically spoon feeding funds to developers to complete those developments. Remember that our thesis has always been based on the fact for the last 18 or pretty much 24 months is that the government's informed view is that they are there to complete developments, not to bail out developers, right? It's which one you need to save actually derives the biggest community and economic outcome is actually delivering the property to the people, because if the property is developed to delivered to the people, then they're going to be willing to spend other money, right? And unlock that level of savings. But expect the property sales will still remain weak. Okay, if you look for the 2022 year, gross average floor space is about down 25%, and for the 11 months to the end of 2023, it was down about that same amount. So it was still going to be a drag on the overall economy. That doesn't mean people aren't going to spend. And that doesn't also mean the developers aren't getting funded, right? So this is looking at 12 years worth of data in terms of how developers are funded. And what you can see here is that there is 5 different channels, right? Where developers get money, right? Either the mortgages, so there's a flow on stage payments that they're getting from the buyers. You've got deposits, you've got self-raised funds. So self-raised funds includes bonds, and then you've got domestic loans, right? So even though as dry as the bond market has been in the last couple of years, that orange bar still exists throughout time. It just peaked in 2021. If you then look at the investment opportunity and what are you then going to talk to your clients about, is this is the entire spectrum of fixed income instruments available. And what you see here is that USD Asia high yield, which is exactly the space that we play in, currently is generating a nominal yield of 13%. Right, our portfolio's yield to maturity is over 12, so it's about where that market is reflecting. Where you see that orange diamond, though, is that that's where the yield was 2 years ago, right? And that was sitting at about 9%. So you can see here that the increase in the nominal yield is partially reflected in risk, but what we do to derate that risk is that we only buy US dollar, right? So we don't buy local, we only buy USD. And that has been actually a feature of our fund since it launched in 2011. If you then consider how that is reflected in another way in terms of risk and looking at relative risk, you see this is those same asset classes in terms of yield. The entire top and bottom of the gray bar represents the actual spread over the last decade. The current spread is the diamond, which is then the number that you see there. And then the blue line is the 10-year average. Okay, so outside of Euro investment grade, there is no other part of the market, and the Euro investment grade is barely above its 10-year average. USD Asia high yield is the only market that is producing an increased level of spread over time, right? Even its 10-year average, it is the most attractive on a spread basis. Again, that's a relative on risk sort of calculation. But what I'm saying is, as I opened with today, the Asian fixed income market is dislocated, not distressed, right? Representing the fact that it is not distressed because no one wants to buy it, right? That's very different to say there's actually a technical problem. With regards to Macau, gross gaming revenue, so we've got about 10% of our portfolio in Macau. Gross gaming revenue is around 90% of 2019 levels, so before COVID, right? And one of the ways to illustrate how we look at things is that the entire industry, so we sum up all the underlying companies of the bonds that we buy in, the industry EBITDA is around $67 billion a year, right? In 2023, that was. And then we cross-reference that against the capex of those companies plus the interest costs, and that number was somewhere between 3 to 4 billion US dollars, right? So that will mean that companies can deleverage. Deleverage being that when those bonds come for maturity, they pay investors back. So the cash flow is really, really strong, right? Operating leverage will increase as the gross gaming revenue continues to increase. Remember, we are talking about in 2023, we're at 90% of gross gaming revenue where the consumer hasn't even tapped their savings, right? And so with Macau, it's a very, very safe market to play in for us, and it provides a lot of family entertainment. And that's exactly where that market shifted for Macau. For those of you that have been there in the last decade, you have seen the mass family-friendly sort of gaming arenas and things like that, and hotels and facilities. That is what Macau represents today, with gaming also still primarily driving that industry. So if you look at our portfolio as it stands today, the fund has done 10% after fees in the last 6 months. Again, reflecting the fact that we came out of the sort of third quarter of last year and position ourselves more aggressively because everything in terms of negative news priced in had been priced in. So for those of you that have, I've caught up with in the last 18 months, we have delivered what we said we would deliver, right? We are not taking away the fact that there was a massive drawdown. That drawdown wasn't driven by us. That wasn't a drawdown that was driven by security selection. That was a macroeconomic event that was centered around Chinese property, which effectively drew liquidity out of the cycle. But we said from the middle of last year, right, there is no better opportunity to start your research to go back into this fund, right, or consider this fund as a new exposure for your clients because all the bad news had been priced in. For those of you that recall, around 6 months ago, the yield to maturity on this fund was 30%. It is now 12, right? So what it reflects is there are still capital gains to be made, and the cash yield is 6.77%, right? We don't take a whole lot of maturity risk on this fund. It's average out at 3 years. This is not a duration fund. It is a credit risk fund, and all the bonds that we hold are fixed rate. So regardless of where rates actually move, fixed rate, these are all fixed rate bonds. There is no floating rate bonds available in Asia. That has just been a historically structural thing. We have maintained through hell or high water a distribution of 6% cash in hand to your clients every year, pay quarterly, and we've paid 2 quarters out. We're looking to obviously pay the next quarter at the end of this month, looking at another 1.5%, and so that's been 3% so far this financial year. And we don't correlate with any other part of your fixed income exposure, let alone your equities exposure for your clients. And in actual fact, it has a negative correlation to Bloomberg Global Aggregate, which is a 50-50 investment grade high yield exposure, right? It's a very, very good way to get sustainable income for your clients without being correlated to anywhere else. You can see real estate is 16% of our fund. In actual fact, China property is around 7% of that. The remainder is actually Indonesia. So Indonesian property has been a very interesting place for us. Obviously, given commodity prices have increased, the fiscal state of a place like Indonesia, which focuses a lot on commodities, has been strong. So fiscally, it's been quite good. They've had an election. We also don't believe that there's any change in policy stance from that perspective. The only thing that we believe is a potential risk on the horizon is if there is persistent weakness in China and therefore exports, there could be some drag-on effect for Indonesia. Again, I reiterate that you're buying this fund for income and cap growth, not driven by earnings, right? That's on the equity side. But you're picking this up for income based on the underlying existing cash flows of companies and their fiscal state being the strength of their balance sheet. You will also note over the last period, we've also materially increased in the last 18 months or so, materially increased our exposure to India. Now, India, for things that's quite interesting, is that fiscally they're quite strong. There's not a huge external debt position for India, and they've also just ramped up a whole lot of infrastructure spending. Again, that's on a macro front. But the Indian high yield market is actually very strong. There's not a whole lot of debt positions there that we find risky at all. On top of that, the onshore financing conditions, right, is very, very strong. Okay, so what do we mean by that? You can issue, if you're a corporate and you're issuing debt into the market, you can issue as much as you like into the market. But if no one wants to buy it, it doesn't matter. So what we're seeing at the moment in terms of the market situation, that with regards to the market situation, India actually provides a very good two to tango situation. You supply the bond into the market, and then there's strong onshore demand, right? That is what is very, very clear that we can see. Further to that, a lot of the money that has gone fiscally from the government has gone to renewable energy. And so a lot of our exposure in India is actually revolving around renewable energy. And therefore, you can see on the right-hand side via sector why there is 16% of the portfolio related to the energy sector overall. We also expect the Reserve Bank of India will keep rates steady for the next year as well. These are our top 10 holdings. As you can see, as I said, we don't try to shoot the lights out or say we're going to try to make up negative performance from 2 years ago. That's not, if you see managers do that, that's obviously of great concern. Our equity funds hold up to 10% as single holding. You can see that our largest holding in the bond fund is 3.8%. So we keep it well diversified. And right now we're holding about 97 names in the portfolio. And you can see that around 70% of the fund will mature in under 3 years. Okay, so while I provided you with some maturity profiling earlier, and it averages out to be sort of 2-ish years, in reality, if I break it down by years, there's a better explanation. And you can see that over 70% of the fund will mature in under 3 years. The other way to also consider where the capital gains can come from is this chart here. So we updated to the beginning of this year. And what this actually looks at is that it's our portfolio potential capital gain reflected visually. So each of these bars represents a half year. So this is all the bonds of the portfolio that mature. And if I take the furthest left-hand side bar, which is the first 6 months of 2024, we have the average price of the bonds that are maturing in the first half of this year is 73 cents. If they all mature without default, then we'll make 27 cents, right, of capital gains on that, and so on and so forth, right? We have only ever had one position default, which was a property developer in our portfolio in the history, in the 12, 13 years history of the fund. But by the time that actually hit default, we had already sold our position down to less than 1%. Okay. So, yeah. You can also see that because of the dynamic nature of the fund, you can also clearly see that our real estate exposure over time does change quite significantly and has remained reasonably flat. And also, we are also very dynamic on our country exposure too. So you can see that we had a height of, at basically the height of the property sector where you could basically, money for jam. In the 2019-2020 period, we had over 90% of our portfolio in China, and now it's under 40%. And then conversely, over time, we've increased our exposure to Indonesia quite dramatically from effectively zero all the way now, it's over 20%. It's closer to 25% of the fund, right? So we're very dynamic. There is no tracking error against an index. There is no benchmark in terms of being over or underweight certain countries and industries. We're just trying to maximize returns for investors in a lower risk fashion. So again, reiterating the points of why is it now the time to invest? You have attractive valuations. Fed fund rates have peaked, which is good for emerging markets overall. And the Asian corporate bond market is dislocated, not distressed. Here are our contact details that you see on screen. For those in New Zealand, please feel free to reach out to Clayton or Mike or Michelle in that case. We've got a couple of questions here that I just want to address. Distributions are based on correct, yes. So the question is revolving around the fact of the 6% distribution is based against NAV. It has to base against NAV because this is not a private credit fund. And just to be clear about that, private credit funds, because of the illiquid nature of the investment, obviously you can pay 6, 7, 8%, right? But our 1.5% per quarter, therefore equating to 6% per year, is based on the 1.5% at the end of each quarter. That is correct. There's also another question is around why separate Macau out of China, Hong Kong? It's still part of China like Hong Kong is. That's actually just based on our reporting system. Frankly, there's actually no specific reason. That's just the way they're reporting. That's how Charles River reports it. So yeah, it's not us specifically doing it, but yeah, that's the way the reporting works. That's all the questions that we had. A copy of this presentation and a recording will be sent out to you, so please feel free to share this out with your colleagues. As you always know, you have our contact details here up on screen and on our website. Please feel free to reach out to us if you have any other questions. We greatly thank you for your ongoing support, and we look forward to reaching out to you soon. Wishing everyone a great afternoon. Thank you.